Hey, welcome options traders. Well, another good question for the group. It actually came in via an email from one of our traders, and he was asking if options reduce risk, how come we still have risk in the market? And that's a really good question. And really, I'm going to rephrase it. What he's asking is it possible for all traders to reduce risk? And so it's an interesting question. And once you understand the mechanics of the options market, you'll see that there's a very clear answer, but it will also help you to make decisions about whether to hedge or speculate. So let's go have a look. Is it possible for all traders to reduce risk? And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start with the options market. Remember, for every option buyer, there must be a seller. That is not true for the stock market, but it's absolutely true for the options market. So if you buy a put, another trader somewhere must sell the put. And so what this means is that certain risks exist in the market. They just have to. Options don't make it go away. What happens is that options transfer unwanted risk to another trader who's willing to accept the risk. The person who doesn't want the risk would be the buyer. They are essentially buying an insurance policy. And the person who is accepting the cash, the seller, is accepting an obligation. They are the ones being the insurance company. So once you realize this, no, not all traders can reduce risk. Somebody somewhere has to end up holding the risk. What the options market is really trying to do is to figure out who's in the best position to hold that risk. And if there's a risk you're willing to accept, or maybe already accepting the risk, and somebody's willing to pay you to continue holding it, why not? Why not take the money? From your perspective, it's not really increasing your risk. Or maybe you're willing to speculate. You're willing to accept that risk in exchange for the money. Money seems to make it very enticing to hold that risk. That's fine as well, but that's acting more as a speculator. But the idea to see is that it's always this idea that we are just shuffling the risk around from one trader to another. Now we can see this with the risk graph. Here's our expiration graph for a $100 call. There's our bend. And we see that in this example, that's the maximum loss of 10. If somebody sells the option, then that would be the maximum gain. So remember, every single point on these lines has an opposite. If the option buyer can lose 10 for all stock prices below 100 at expiration, then the option seller must make 10 for all prices below 100. Out here at 130, we know that if the option buyer can make 20, that would be the profit, then the option seller must lose 20. So again, it's just shuffling the risk around. Notice that it doesn't make it go away. So for example, here's long shares of stock, purchased for 100. We all know that it's a straight line up and down, and that just means you're earning dollar for dollar as the stock price rises and losing dollar for dollar as it falls. Well, let's say that you don't want the risk below 95. Well, you could buy a 95 put. And what that's going to do is it's going to flatten this portion of the risk graph. It's going to give us that classic hockey stick shape. And you are now eliminating all of this downside risk below 95. Well, you might also recognize this red segment plus this as a synthetic call. That's just stock plus put. And if you're thinking, okay, well, I'm willing to hold the downside risk, well, maybe you could sell the 95 put, and that would put you synthetically back into shares of stock. And that might be a perfectly good reason for selling the put. So the thing to take from this, remember that the whole idea of the options market is that options don't eliminate market risk. What it's trying to do is to answer a very, actually complex question. Who's in the best position to accept the risk? How can we efficiently divide this risk up among hundreds of thousands or millions of traders? And the options market is very efficient. You just simply look at the prices. If there's a risk you don't want, here's what it's going to cost you to hedge it. If there's a risk you're willing to accept, here's how much somebody will pay you to accept it. That's all you have to know is the price. So once you understand this concept, that options don't make the market risk go away, it really emphasizes why it's so important to start by setting a goal. We have to have a goal before we can even define risk. And after you've defined your goals, if there's an unwanted risk, well, now you know exactly what and how to hedge. And if you're willing to accept a risk, you can get paid to do it. So just remember that when it comes to managing risk, risk will always exist in the market. Hedge any unwanted risk before the trade. Now, there's another interesting insight to this once you understand that options don't make the market risk go away. You can also figure out why it's a myth when you hear people say that you are trading against market makers, that it's us against them. And that's what makes traders make bad decisions because they don't realize that the market makers aren't just holding all of the risk, they're spreading it back off into the market. So, for example, let's say that you wish to buy a 100 call. And one way to understand this is to say this is the risk graph that you would like to own. So we can think of the market maker as saying, well, let me go build this risk graph that this guy wants, and I can build that by buying stock plus put. That again is the synthetic call. And look at those two risk graphs, they look exactly the same. So how can the market maker transfer this combination of stock plus put over to you? Well, if you want to buy the call, then he has to sell the call. And that is what transfers that risk profile over to you. But now something interesting happened. Take a look at these three pieces. If the market maker is long stock, long a put, and short a call, what does that do for this risk graph? It goes to here. This is called a conversion. It's going to behave like a T-bill. He's actually out of the market. He doesn't really care what happens to your position. It is no longer us against them. Now, for the market maker to have purchased stock, somebody somewhere in the market must have sold stock. Whether it was selling a long position or a short sale, somebody had to sell him the stock. And in order for the market maker to buy the put, somebody somewhere had to sell the put. So take a look at these two positions out here. Short stock, short put. What is that? That is the same thing as a short call. And now you can see that you are actually paired up with other traders in the market, not with the market maker. So now you can see that the market maker is actually out of the picture. It's not you against the market maker, it's you against other traders in the market. And so it's an important concept to realize that in the market, there is always an inherent level of risk. Yeah, that risk can increase or decrease at certain times, but whatever that level of risk is, it never goes away. All you're doing with the options market is shuffling around who's going to hold the risk. So that'll give you a different perspective on the options market. So if there's a risk that you don't want, now you know the answer is to hedge it. If there's a risk you're willing to accept, you can get paid to hold it. And why not use both? Why not get paid to accept some of the risks, take that cash, and hedge away the risks that you don't want? And that's a much better way to approach the market than thinking that everybody can eliminate risk or that it's us against the market makers. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.